Olá, estamos aqui para mais uma entrevista. Agora estamos com um convidado gringo aqui, né, o David, que vai falar um pouquinho para a gente quais são as perspectivas agora para o mercado de crédito. Ele vem da Oaktree, que é uma das gestoras americanas mais famosas nesse mercado de crédito, para contar um pouquinho qual que tem sido a visão dele. Well, thank you so much for the interview, David.
Thanks for having me.
Yeah, it is a pleasure. So let's start. The previous week, Federal Reserve Chair Jerome Powell said, he said that the time has come for policy to adjust, right? So the path seems that United States are going to start the easing cycle in September. That is the view that Oaktree has right now?
I think yes, and the short answer is yes, but it's a little bit caveated because the market, I think everyone will agree September, he's made it very clear he's going to start. But the market has decided that means we're going to have 4 rate cuts in this year, another 4 or more rate cuts next year. And what I remind people is the world that justifies 8 rate cuts in less than 2 years is not a happy place. The economy is in a very big problem because that is massive stimulus, which means there has to be a crisis to justify that stimulus. But right now, if you look at the economy, while things are slowing down, they're not slowing down, in my opinion, to a red alarm warning. I think things are actually grinding along.
So it's not a recession.
I don't think so.
We're not facing a recession.
I think we're going from strong growth to weaker growth, but that's still growth, right? And so what I think has happened is the market has determined that a cut in September means a cut in September, a cut in November, a cut in December, and so forth. But a cut in September could just mean a cut in September. And I think that's the part that the market needs to absorb because the market is expecting this step function drop in rates. But a more logical outcome would be a smooth glide path on rates. Because think about it, historically, someone had reminded me recently that the Fed always cuts multiple times when they cut, always. And I like to say that always and never are dangerous words to use in investing. But then you kind of think about why is that? Why is it that the Fed always cuts successively? And over the last 40 years, it's because when the Fed was cutting, it was to avert a crisis. When you're averting a crisis, you need to shock an economy back into action. We're not averting a crisis now. Now what Powell is saying is, I think we're getting inflation near under control. And if you keep inflation too much higher above, or keep rates too much higher above inflation for too long, you create a recession. He's trying to get in front of that. But if you're doing that, I imagine you would do it slowly. Because if you do 8 rate cuts very quickly, that creates inflation, just by definition. And so I think it's more logical that we're going to see rates come down, but come down in a slow, more measured pace so they can see what the impact is, make sure that they're not slowing the economy too much as they do this. And in that scenario, quite frankly, there's certain areas of the market that probably need to reprice.
Okay, perfect. So you're thinking that the rates will cut down, like Fed will cut the rates until
slowly.
What?
Well, so that's a great question.
Yeah.
So I was having this conversation with Howard Marks, and he was commenting that everybody says we're in a new normal in rates. New normal. Everything's different now. And basically saying that rates are going to go back to near zero because that's where they were. And Howard made the comment, said this is not the new normal. This is the old normal. The abnormal part was zero interest rates. It just lasted a decade and everyone got used to it. Rates at this level are normal, which means this whole narrative that rates need to go back to 0 to 1% just isn't true. Rates can go back to 0 to 1% if there's a crisis to justify it. Without that, I think having rates in the 3 to 4% range is more reasonable, which means they just still need to come down, but not quite as much or quite as quickly as everybody wants them to.
Okay, so between 3 and 4%, right?
Yes.
So if the Fed start this easing cycle in September, what could occur for the debt market? What could happen to the debt market?
Well, so you think about it, it has different impacts on different parts of the debt market. So floating rate debt, the yields will start coming down, what people are earning, because as rates go down, their yield floats down. On the fixed rate debt, you have what we refer to as duration or sensitivity to interest rates, which means as rates go down, bonds will trade higher and you'll make a profit. And so there's different pockets of the market that will react differently. But I still go back to it depends on why. If the Fed is easing because things are grinding along, the economy's in a good place, and they're just trying to keep from creating a recession, I think most, at least on the below investment grade market, which is where I traffic, I think most credits are going to be okay. If the Fed starts to really put the pedal to the metal, that means something bad just happened and credits are in trouble and spreads are widening and people are worried.
Okay, and we see a decrease in the spreads offered by U.S. corporate bonds. So what are the perspectives for next month? Should we keep seeing this decrease?
Not necessarily.
No.
So I have this debate with so many people of spread versus yield, right? And what I found is that over the past 10 years, rates are near zero. And as a result of that, the yield in below investment grade was about 4 to 5% in US dollars. And quite honestly, that wasn't sufficient to justify taking the risk. So people would only buy if they could get a total return on top of the yield, right, to justify the risk. So in total return in bonds is driven by wide spreads. It's just the math of a bond. You cannot have a bond trade up unless spreads can compress. And so what you found is for the past decade, everyone has kind of what I like to call become tactical investors. They buy bonds when spreads are wide and they jump in. When spreads are tight, they jump out. Jump in, jump out, and they're constantly trading bonds almost like equities, right? Well, now we've gone through what our chairman likes to refer to as a sea change in rates. And so now you can earn 8% in US dollars, or in real about 13. And now I go to people and say, well, if you can get 13 in real, do you really need a total return on top of the 13? And most people say, no, the 13 is sufficient for me. And so they're buying for the yield. And so what you're observing now is, as a result, because the yield is the driver of the purchase, you're seeing that when rates go down, spreads tend to widen. When rates go up, spreads tend to tighten because the price is staying the same because people are buying on yield. And I think that's an important shift. I call those investors strategic investors, because instead of jumping in, jumping out, you buy it and you forget about it and you sit on it, and a year later you've clipped 13% yield.
It's like you buy and hold.
Exactly.
Yeah, the same strategy
exactly
for
right.
the equity market.
Exactly. And so that's kind of where I see things headed. And we've seen it because there's been so much volatility. This market has gone from soft landing to no landing to hard landing. They're all over the place. And bonds have been fairly stable through it all. Because what you're seeing is the incremental buyer for bonds is saying, I just want to buy for the yield and sit on it. And there's a piece of my portfolio where if I can carve it out and move it over here and forget about it, in a couple years, 3 years from now, let's say I've made 13% a year for the last 3 years, that's sufficient. And that buyer is much more stable, and so they're not reacting to all these movements.
Really nice. Okay, and you talked a little bit about volatility, right?
Yes.
So if the Fed starts this easing cycle, that could create a little
Yes.
bit of volatility.
We saw that a couple weeks ago.
Yeah, totally. So what are the expectations for the next month? Should we see an increase in terms of volatility or not? How can the investor try to invest in this scenario?
It's an interesting question because we have seen, and it goes back to the why. I think what happened for the longest time, the market had decided we were going to have a soft landing and still get 6 rate cuts because I think people just wanted it because it would be really good for everything they own. And now I think the market a couple weeks ago had a bit of a panic because all of a sudden they realized, hey, we think we're getting the rate cuts, but it only makes sense if we're in a hard landing recession. And so then equities took a dive. And I got a lot of calls from clients that day, everybody calling saying, oh my gosh, sky's on fire. What are you guys doing? But what I found interesting is while equities were down 10%, bonds were flat. And so what you find is that with equities, you need growth, right? That's a simple model. You have growth, you put a multiple on your growth, you value your equities. And, over the last 10 years, we've had tremendous growth because money was free. Turns out when money's free, people borrow a lot and they take all this free money and they build factories and they invest in growth and you have all this growth. But debt, I don't need growth. I only need companies that generate enough cash to pay me back. And if they do that, I get a contractual 13% return in real. And so that becomes very attractive. So what we found is that the equity market woke up one day and said, oh my goodness, we've priced in way too much growth. And equities repriced. But the debt market said, that's fine, we don't need the growth. And equity and the debt market was very flat. And so I think when you think about, and I know we'll talk about election in a minute, and that's another driver of volatility. But when you think about volatility, I think having debt in your portfolio is a very powerful tool. Because, I had a conversation with Howard Marks 2 days ago where he said, quite honestly, volatility is noise. The key to volatility, the only time volatility hurts you in debt is if you capitulate and sell. You sell at the wrong time. But if you're doing a good job picking credits, and I believe Oaktree is the very best at picking credits, and so if you can pick credits, then bonds can trade up, they can trade down, but they mature at par. And if you sit on it and you hold it to par, you know what your return is. It's contractual. And I think that people are kind of waking up to that because it was always true, but a contractual 4 or 5% doesn't matter. A contractual 13 matters. And so I think that's become a more important piece of people's portfolio.
That's nice. And you were saying that equities, they need growth.
Yes.
So right now, we're going to be able to see a slowdown in terms of
I
growth.
think so.
So the market is going to be more in favor. It's going to be more favorable, let's say, for that rather than equities.
I think so, but I'm a debt guy, so take it with a grain of salt.
You have a bias.
but think about this in just logically. So we had all this growth over the last 10 years in equities. Well, now money's expensive. And as we just talked about, I don't think the Fed is immediately going back to 0 to 1% interest rates without a crisis. And if we have a crisis, everything's trading down. And so if money stays expensive, at least relative to where it was, you're going to be able to borrow less. And if you can borrow less money, you're going to be able to fund less growth, which means you should have less growth. So equities are going to need to reprice, in my opinion, for a world that grows a little bit slower than it has. But again, debt, if you can lock in good yields, is just going to keep grinding out a coupon. So there was a strategist that said this much better than me. He said, I like debt better than equities because with debt, the return is contractual. So in Brazil, you buy our multi-strategy portfolio. If nothing happens, you get 13%. In equities, if nothing happens, you get nothing. And that's really the key, is you're betting on growth, and I think eventually growth has to slow.
Okay, really nice. And I was reading an article, and there they said that they see like a tremendous divergency around high quality bonds, because they were saying that some central banks are starting an easing cycle, and meanwhile other central banks, for example Japan, they are waiting a little bit. They have inflation challenges, but they are waiting a little bit maybe to increase rates. So do you see this divergency in terms of high quality bonds right now?
I think you do. We do mostly below investment grade, and we don't do sovereigns, we're doing credits. But if you just look at the economies, Japan is the poster child. They kept rates low for too long. They've realized that stifles innovation, and so now they need to kind of get themselves out of this rut. And doing that is going to kind of, certainly wreaked havoc on the carry trade for a few days. And so, that's going to happen. But when you look around the economies and you think about central banks and what they do and why they do it, and I believe all central banks are really in a position now where they're looking to make sure that if the economy's in trouble, they step in very quickly. I think COVID showed that globally. Well, the U.S., as we talked about, don't think it's, in the red zone just yet. So no need to be too aggressive. Europe also doing okay. And so I think those areas of the developed markets are doing fine. China, there's some question marks as far as kind of what's going on, real estate sector in particular. And I think other emerging markets have, inflation. Brazil, they're talking about raising rates. And so with everybody kind of moving in different directions based on where their economy is heading, it's going to drive relative value.
Perfect. Well, I'd like to ask you right now a little bit about the U.S. elections.
Yes, a popular
I know that's,
topic.
Yeah, your favorite topic.
Yes.
So I was wondering, how could the U.S. elections affect that market right now?
Sure. So if you think about the election, there's a few things you got to remember. Depending on who wins, obviously there's very different policies that could come in place. Trump has been very vocal about putting on tariffs. Tariffs by definition are inflationary, so as everyone's saying rates are going down, maybe there's a pressure to keep them higher. If Kamala were to win, Democrats historically have been big spenders. I haven't met a politician that doesn't like to spend money, but spending money has to be funded, and usually that's funded by selling treasuries. So again, something that could put upward pressure on rates potentially. And then you have the regulatory environment and all this uncertainty. But the way I come back and kind of look at it is Howard wrote a memo about this the last time Trump was president. And when Trump ran against Hillary, he said the market had determined that for sure Hillary was going to win. And for sure, if Trump won, the market was going to panic and trade down. And neither of those turned out to be true. And so I think Howard's point was not only do you not know how the election is going to play out, you don't even know how the market's going to react. I mean, look, there's so much uncertainty in this election. It was not that long ago, small cap stocks were really popular in the U.S. because tariffs are going to be really good for domestic small companies. And then Biden dropped out of the race, and that whole trade just imploded. And so how do you analyze the probability that Biden...
Now they already know Trump.
Exactly.
Yeah,
and so... And you don't have an economic plan yet in detail from Kamala, and so it's hard to know. But what I can say is, look, when Trump was running against Biden, the probabilities were very high for Trump to win. Now it's about 50-50. And so what that means to me, if the odds are 50-50, no matter who wins, half of the people are going to be upset about it. And so that means you're going to see volatility. And so for me, I always say, back to Howard's point about volatility is opportunity, especially if you have a multi-asset portfolio. You can sit grinding out a good income, and depending on what dislocates and why, you can very quickly move around and take advantage of opportunities. I think that's coming. I think you're going to see volatility from the election. I think we'll see volatility because of the debate about where rates end up. I think you could see volatility from geopolitical events, Middle East, Russia, Ukraine, China, Taiwan. There's all sorts of things that could spook everybody on a moment's notice. And so I think there's reasons enough to watch, but I think that creates great opportunity if you're watching the markets very closely.
Okay, so you talked a little bit about opportunities. So
yes.
Where are the opportunities right now? Could you say, I don't know, U.S. corporate bonds, or you rather choose European bonds?
So I like having a multi-asset portfolio because I don't have to pick one thing. I have this whole menu of things that I can invest in. But right now, I would say we're leaning more towards, I'd say, U.S. bonds and European loans. And European loans are a little bit cheaper than U.S. loans. They don't have as many CLO activity and buyers, like ETF buyers and so forth in Europe. But I'm kind of more developed market, if you will. Because again, if I can get a good yield without having to take a lot of risk, feels like a good place to be. And wait and be patient. I always say to people, patience in investing is very important. Almost always rewarded. The truth of the matter is I can be patient. People aren't always patient with me. And you're getting 4 or 5%, people take their money. But now in REI, I'm getting 13. It's pretty easy to be patient at 13. And so I can wait and be in what I believe to be the higher quality spectrum of what we invest in, and wait to see what dislocates. Because think about asset categories like real estate debt. Well, if rates don't go down as quickly as people hope, that could have an impact on valuations for real estate, create an opportunity. Think about convertible bonds. They're tied to equities. Equities are very closely tied to whether or not we're getting a pivot. And if we get the pivot, but it's not as quick or as dramatic as the equity markets want, you could see a repricing in equities. That could be an opportunity. The truth of the matter is, since I brought up real estate debt and converts, those are probably not the two that are going to dislocate because I'm watching them, and that's how markets tend to go. And so again, that's why I like to go back to having a broad menu of things to look at so I can watch and wait to see what the dislocation, where the dislocation comes.
So right now you prefer U.S. and European bonds, right?
Yeah.
So what about Brazilian bonds?
Yeah.
Since you are in Brazil,
So
I have to do this question.
I think it's a fair question, and everyone I talk to here is very proud of the Brazil economy, which is doing well, and I think there are some great opportunities. We do have some investments in Brazil. But what I would say thematically is we're keeping our emerging market exposure very low right now because we don't need it, right? If I can get 13% out of developed markets, that's good enough for me. I don't need to be a hero reaching for yield if I have all these things that could add volatility that we talked about earlier. And so we're generally leaning away from emerging markets, waiting, because what happens, you go into the emerging markets, if you buy the higher quality emerging markets, which we like to buy high quality, then it tends to be trading roughly in line with what you can do in the US or in Europe. And so you're not getting a meaningful premium today. And that changes. I've been doing this a long time, and we see this change. And so, again, if you're patient, you know the opportunity is coming. And so we're watching.
And what do you think needs to happen in order for the Brazilian bonds to be more attractive
Honestly,
compared to U.S. and European bonds?
Yeah, it's very simply a matter of price. And so I think that if the U.S. market were to rally dramatically and Brazil would not, or if the Brazilian market were to trade off, in the U.S. not. If you see a gap in yields between Brazil and the U.S., that's when we tend to get interested. And then we start looking for individual companies that we think are very solid, and we'll start looking for things to do. But right now, the spread between the two is too tight.
Okay. Well, in Brazil, we are discussing a little bit, maybe a start in increasing rates. So do you think this gap yield will become a little bit bigger, or?
It's possible because, simplistically, when rates go up, bonds tend to trade down. And so depending on how much movement in rates you see, and depending on kind of the big driver, the why, is it because the inflation's becoming a problem and they need to get in front of it, you could see it for sure. And that's something we check every week. We sit down and meet with our experts in the EM, and because we have some portfolio managers there that are very talented, and we just check in. Are you seeing good value? And so we're constantly asking, and when that opportunity comes up, we'll be ready.
Okay. So last question. So since you are a foreigner, I would like to know what is the view that foreigners have about Brazil right now? Do you think you said a little bit that Brazilian economy is strong?
Well, it's a commodity-driven economy, right?
Yeah.
And so agriculture in particular, and those are areas that generally have good secular growth to them as the population grows and you need to feed all the people. And so I think there's generally, a strong view, but it does come with volatility. There's been plenty of volatility in Brazil. I would expect that to continue like most emerging markets. And so for us, we just have to weigh how much you're getting paid versus the volatility is coming and is it sufficient?
In terms of foreign investment, do you think that Brazil is attractive now? When you talk to other investors in the USA, do you think that they mention Brazil a lot, or Brazil is not mentioned at all?
I haven't heard it a lot, but that's why I like it.
Okay.
I like going to look at things that people aren't talking about, and I like running away from things that everybody's chasing. And so I haven't heard a lot of it. Frankly, one of the things I've been talking with a lot of Brazilian investors about is the ability to go offshore. Because a lot of Brazilian investors understandably love to invest in Brazil, but you should never do 100% of anything. And frankly, if you look at the high yield market, for example, in Brazil, it's very small. I'll call it roughly 40 companies, very difficult to diversify. In the US, it's over 1,500 companies. It's very easy to diversify, so you can move into a market where you're going to reduce your risk because you're diversifying your portfolio, which is always a good idea in credit. And so I think that's a really good opportunity right now.
Okay, perfect. Okay, thank you so much for the
Thank you.
interview, David. It was a pleasure. So see you next time.
Looking forward to it.
Thank you so much.